Hello, everybody, and welcome to another edition of BullionStar Perspectives. My name is Ronan Manly, and today we're delighted to have with us Brent Johnson, who is CEO and founder of Santiago Capital. Hello, Brent. You're very welcome.
Thanks for having me. I'm happy to be here, and it's nice to talk to you again.
Yeah, I remember we met in London about 7 years ago, but that's a long time ago, so it's great to catch up now. And I think that there couldn't really be better timing for our interview today because of everything that's happening in the currency world. And with you being an expert on the dollar and the currency movements, I think that our audience are going to get a lot out of it. So I thought we'd start off by just looking at what's going on right now with the dominance of the dollar. Is it something that you expected to be happening right now at the end of September 2022, or did it catch you unawares, the sheer acceleration of the moves that we're seeing?
Well, I wouldn't say that the level has surprised me. I kind of, I've kind of expected the dollar to do this. What's been interesting to me this year, because things are always interesting, even when you sort of get things right, there's always these nuances that make it very interesting. And that is that, the dollar has in many ways performed just as well, if not better, versus, the other major currencies as it has against a number of the emerging market currencies. We've seen, double-digit falls in the UK pound, the British pound, the euro, and the Japanese yen over the last 12 months. Those are very, very big moves for currency markets, especially yes, for major currencies. It's a little bit unheard of, to be honest. So while I was expecting it, it's always interesting to see it play out in real time.
People might be aware of the DXY index, which is an index representing a basket of 6 currencies. But the major weightings in that are the euro and the pound and the yen. I remember seeing when you were being interviewed recently, you were talking about a target for the DXY, and that, I think it was on Twitter actually, and that right now the DXY index is at 114. Has it met your targets, or have you been now revising your targets and you think that the DXY is going to go higher as the other major fiat currencies, which that represents, go lower?
Yeah, so ultimately, I think the dollar is going to go much higher than now. I think it's going to be very hard for the world to keep it from going higher. Now, having said that, I don't expect the dollar to go straighter or higher in a straight line. You just mentioned that the DXY is at 114. It started the year at 95. So that's close to a 20% move this year. That's on par with some of its biggest 12-month moves in history. So while I'm always ready for the dollar to spike higher, I kind of expect it to take a little bit of a pause here. It would be kind of a natural time for it to take a pause. I think in some ways the US wants the dollar strong right now, but they don't want it so strong that it brings down the entire system. So it wouldn't shock me at all if we get a little bit of a pause here in the dollar. That said, I also should probably point out that I expect this to kind of play out over a number of years. I don't think this is something that necessarily plays out over 2 or 3 months. It could easily be another 2 or 3 years, potentially even longer than that. But I guess the point, what I would say is that we're going to have these periods of times where the dollar gets strong and then it pulls back, and then it'll get strong again and pull back. So I expect it to be kind of a stair step as opposed to just a runaway freight train. But the problem is once the dollar gets going, it's very hard to stop it. So you have to be prepared for the freight train, even though that's not what I'm expecting.
So would you be able to share with us a little bit of the framework in how you look at the dollar and how you were so successful in predicting that this strength of the dollar is playing out? I.e., would you be able to share with us what a lot of people know you for, the Dollar Milkshake Theory?
Sure. So the Dollar Milkshake Theory was it's really a framework for how I see a sovereign debt and a sovereign currency crisis playing out. And what kind of set me on this path was probably, to be honest, Ronan, about the time that I met you in London. It was probably in the 2014, 15, 16 timeframe. I don't remember exactly, but I remember in the fall of 2014, the dollar got very strong. And I, to be honest, just didn't understand why. And I thought that the dollar should have been getting weaker. Instead, it was getting a lot stronger. And so at one point, And I talked to a number of different people, and they said, "Oh, don't worry, it's going to weaken. It's going to weaken." And that didn't quite do it for me, I guess, for lack of a better word. So I needed to kind of understand what was going on. So I really kind of dug in. I kind of went back and I really kind of dug into the monetary system again and tried to figure out, what were the mechanics that would cause currencies to move, and then why it wasn't doing what I was expecting it to do. And a little bit in conjunction with that, I kind of made a shift in my thinking, as opposed to thinking what I wanted to see happen, as opposed to what I thought was actually going to happen. Because I am someone who manages money for other people, I kind of have a fiduciary duty to not just invest where I would like to see things, work out. It's like they've entrusted me with their money. They didn't hire me to be kind of a financial justice warrior or say this is the way this should be or this is the way that should be. What they've hired me to do is figure out what's going to happen and profit from it. And so it was a little bit of going back and revisiting my entire thesis of kind of the monetary system and being open to being wrong, because I had been wrong for a long time, and I wanted to figure out why I'd been wrong. So I'm sorry for that's kind of a long way of setting up for this answer, but what I discovered in kind of going back and redoing this analysis was that my previous analysis had really focused on the United States. I think probably a lot of your listeners are familiar with the fact that the U.S. has huge budget deficits. They've borrowed an enormous amount of money that they can never pay back. The politicians always spend more than they have. They did this when interest rates are really low. And now when interest rates rise, there's no way they're going to be able to service the debt. And as a result, they're going to have to inflate it away. It's all perfectly logical, and it makes a lot of sense. And I think it will someday play out. But what I discovered when doing that is that every other country was doing the same thing. And I guess I never just really thought of it that way, right? I figured because the United States was the global hegemon and the global leader, they could just do whatever they wanted to. And, the rest of the world would just have to deal with it. And while I still think that is the case, because I had thought that way, I never really analyzed other countries. I just analyzed the United States. But when I started analyzing other countries, I realized not only are these other countries in a very similar situation, it could be argued that they were in a worse situation, and they didn't have the same demand for their currencies as there is for dollars. And what I mean by that is that a lot of people in the US, perhaps differently than where you grew up in Ireland, and perhaps differently than your neighbors in Brazil or your colleagues in Singapore, people in the US grow up thinking in one currency, right? But people in the rest of the world grow up thinking in two currencies. They think in their local currency, and then they think in US dollar terms. And the reason they grow up doing that is because the US dollar is used to finance trade all over the world. And so, not only that, so there's a demand for dollars outside the United States. I had never really considered the demand for dollars outside the United States. So that was one part. And the second part is because there's so much demand for dollars outside the United States, excuse me, it allows other countries and entities outside the United States to borrow in dollars. And because there's so much demand for dollars, they're able to borrow at a lower interest rate. So it makes their financing cheaper. So they can borrow in dollars. So then they borrow in dollars. Well, if you borrow in dollars, then that's demand, that's future demand for dollars as you have to service that debt and pay it off. And then I thought, well, but that could just be defaulted on and that would hurt the United States. But then again, because I went back and dug through this, just because that debt was in dollars didn't mean it was owed to the United States. It was actually owed to other entities outside the United States. So it was a French bank making a dollar loan to somebody in Turkey. It was a Chinese bank making a dollar loan to somebody in Vietnam, or it was someone in Brazil selling soybeans to somebody in Japan, but denominated in dollars. And so, if the rest of the world ever did default on their US dollar debt, they would kind of be defaulting on the rest of the world, not the United States. So when I started kind of figure all this out, it kind of almost flipped me around 180 degrees. And it made me view things much differently. And once I did that, it was much easier for me to navigate the process. Now, I'm not going to sit here, Ronan, and pretend that I've gotten everything right. And I'm certainly not going to get everything right in the future. But having this new framework allowed me to kind of be prepared for what's been happening, call it the last year or two.
Given that there is demand for dollars, which could be exponential, and given that there was a huge creation of liquidity after the great financial crisis beginning in 2007, 2008, when you refer to a milkshake, are you referring to that huge ocean of liquidity that for some reason, well, for particular reasons, will go back to the dollar? And that's what you refer to as the sucking up of that liquidity that goes back like a wall or a wave of other currencies converting themselves into dollars and going back to reside in the US. Is that what is making the dollar stronger?
Essentially, there's two factors. Well, first of all, I should say you do have it correct. And okay. the explanation that you're giving is the right way to think about it. The way I've explained it is, again, after the global financial crisis, again, I think I know a lot. I think a lot of people understand that the U.S. created a lot of new money. Just for lack of a better word, let's say they printed a lot of new money. But it must be remembered that Japan did the same thing. Europe did the same thing. China did the same thing. Brazil did, every kind of buddy did the same thing. What's different is that for a long period of time in between 2008 and COVID, the United States stopped doing that, right? Whereas Europe kind of continued doing it the whole time, and Japan continued doing it the whole time. And so while, the US was definitely guilty of doing this and creating this excess liquidity and, debasing the currency, for lack of a better word, other countries were doing it at the same time. And so so what I said was there had been this big milkshake of liquidity that had been created by the whole world, not just the United States, by the whole world. But then going back, and that's the supply side. So everything in economics ultimately comes down to supply versus demand. So that's the supply side. All of this new liquidity or capital or money, however you want to define that, was created. But if we flip over to the demand side, the demand for the dollar on a global basis is just much, much bigger, multiples bigger for the dollar than it is for any other one currency. So even though the US had created a lot of money on a relative basis for the whole world, they had not. And so then I said what I thought would happen is that we would get into a situation where all of the debt that had been created and all of the money that had been borrowed would eventually, you're eventually going to hit that wall, right? And when that happens, and not just for the United States, for the whole world, Europe would hit the wall, Japan would hit the wall, China would hit the wall. And when that happened, I thought there would be more demand for US dollars than there would be for these other currencies. And I thought that would allow, the global capital would seek out the US dollar and US markets as opposed to Chinese markets or Japanese markets or European markets. And that would cause the US dollar to go higher relative to those currencies. And then as a result of the capital leaving those other places, that would deprive Europe of capital. It would deprive Japan of capital. And so what those governments and those central banks would have to do is they would have to print even more to supply that liquidity that was needed. And that's kind of what we've seen over the last couple of years. We've seen, after COVID, everybody kind of printed again. But then when we started having inflationary effects, the US, because there's so much demand for dollars, the US was able to raise rates more so than the competitors in Europe and Japan. Because we were getting the capital flows and because there was demand for our currency, our markets were holding up better. The US has been able to raise rates 4 or 5 times this year, and much more so than people thought they would be able to. And part of the reason is because of that demand for dollars. Japan and Europe have not been able to raise rates to the same extent. Now, Europe has finally raised rates a little bit, and that's helped the euro a little bit, but it's nowhere near what they've raised them in the United States. And Japan hasn't been able to raise them at all. So the point is while the US is tightening monetary supply, The other two places are still providing that liquidity that's necessary. So on a relative basis, the dollar is getting stronger.
So it looks like a feedback loop. And there are definitely implications for this, because if non-dollar economies use dollars and borrow in dollars, they have to service the principal and the interest payments in dollars, and there's potential risks for default. But also at the same time, there could be unintended consequences or unforeseen consequences of currency crises or sovereign debt crisis. So what do you think is the end game here, or will it to play out?
So, well, the end game, I think, is you'll see other currencies fall dramatically versus the dollar, even more so than they already have. You're starting, but what I think it will cause is it will cause social unrest even more so than we've already seen. You can already see this in places like El Salvador. You can see it in places like Peru, Sri Lanka, Ghana, even Egypt to a certain extent, Turkey to a certain extent, where these countries have demand for dollars because they've either borrowed in dollars or they have to import a lot of food and energy, and it takes dollars to do that on a global basis. And so they've had to provide more of their local currency. They have to print their local currency to be able to go buy dollars to then get these imports. But that causes, again, their currency to fall. And so when their currency falls dramatically, that causes prices locally to rise a lot, right? And so that's when you end up seeing protests. You know, people typically don't protest when they're warm and happy and not hungry. But when they're cold and frustrated and not making any money and they can't get any food, that's when they start getting pissed off and they start going out into the streets with pitchforks, right? Yeah. And so, you know, if you look back throughout history, typically whenever there was a revolution, it was because of, you know, some kind of a crisis due to high inflation. I mean, I don't think you can ever find much of a historical revolution that took place when there wasn't some kind of inflationary pressures. I may be wrong on that, but typically that's what you see. And so I think we're going to see more of that. Now that I want to caution though, is this is not something that I necessarily think is going to play out over the next 2 or 3 months. It could, and I think you have to be ready for it, but more than likely what I think will happen is, you know, at some point, you know, maybe even relatively soon, the central banks will have to get together and do something else to kind of relieve this dollar pressure. And so maybe the dollar will pull back for a couple months, couple weeks, maybe even 6 months. I don't know. But then I think we're going to, because the other countries are going to have to keep printing their own currencies, I think the dollar is ultimately going to go back higher. Ultimately, what I think will happen is as we get further into a currency crisis, get further into a sovereign debt crisis, is these countries won't be able to sell their bonds. And so they're going to have to start printing money to fund their governments. All that money that is printed, anybody that has any excess money, I think they will buy dollars and invest it in the United States as opposed to invest it in their local currencies. So I think it's possible you'll see hyperinflation in smaller regional countries around the world. Ultimately, I think this can potentially happen to the dollar, but it will. I think it's the last in line of all the dominoes to fall. And the point I would like to make is this is not something that I like to see happen. And even though I think the U.S. and the U.S. dollar will be better on a relative basis, it doesn't mean the U.S. and U.S. dollar are good, right? It just means they're better. It just means they're better. So, and this is, you know, this kind of a sovereign currency crisis that plays out in this manner, if it happens, to me, this is kind of the worst of all worlds because it's really hard to fight against because these countries are getting it from both sides. And what I mean by that is, global growth is slowing. So their revenues are not as high. So you've got your top line revenue coming down. The government, though, is having to print money to make up for that slowing growth. So their local currencies are falling in value, which means their import costs are rising in dollar terms. So they're getting inflation in local currency terms. They're getting deflation in US dollar terms. And so they're getting squeezed. The top revenue's coming up and their costs are rising. So that profit margin is getting smaller and smaller and smaller. And so they're dealing with both inflation and deflation at the same time. It's really hard to institute a policy to solve both inflation and deflation at the same time. You typically have to try to solve one or the other. And I should point out, Ronan, that the U.S. is struggling with this too. You know, the Fed is raising interest rates to combat inflation. The raising of that interest rates is making the dollar stronger because it has a higher yield than its peer currencies. Capital's rushing into the dollar. That pushes the dollar higher. With the dollar higher, it becomes harder to finance, any dollar debts, and it becomes harder to U.S. profit margins get squeezed as well. And so that can lead to defaults, and that can lead to asset prices coming down. Well, that's what you're seeing right now in the U.S. stock market, right? So far, the Fed has said we are more concerned with dealing with the inflationary pressures than we are with dealing with the deflationary pressures. They've said we are happy if you lose your job and get paid less if we can bring the overall inflation rate down, which is a little crazy if you think about it, but that's so far what they're doing.
You mentioned about temporary intervention, that central banks might be able to delay some of the fundamental trends that are happening with the dominance of the dollar. But do you think it's possible that they could meet in the same way that they met in 1985 for the Plaza Accord, and they agreed a deliberate depreciation of the US dollar? Do you think that's something that the central banks of the world might be looking at right now?
I don't think that they're looking at it yet. And I'll tell you why. And listen, this is something that I could be totally wrong about. But the reason I don't think they're looking at it yet is number one, I don't think the pain is quite to that level yet. It could be, but not quite to that level yet. Number two is in 1985, the U.S. wanted a weaker dollar. I actually think right now the U.S. is happy to have a stronger dollar. And so I don't think that they would want to weaken it right now. And then number three, I just don't, I don't think that, changing a system or having another Plaza Accord, it's a pretty big event, right? I mean, it's a pretty big deal. And to a certain extent, you need global coordination to do that. Right now, we've kind of got global, for 30 years, we had globalization where everybody was kind of using the same supply chain and, working together, and trade was free and travel was, could freely travel. But now, over the last couple of years, especially since COVID and then with Russia and Ukraine, you've kind of got this bifurcation, right? Where the world is kind of picking sides, East versus West, China versus the United States, Russia versus the United States, Russia versus Europe. You can divide it in a bunch of different ways, but, the BRICS versus the West, there's a number of different ways that you can divide it. But the point is it's becoming more fragmented, rather than more than one globalization. And I'm not sure that right now, because I think the U.S. is trying to make people choose sides. I think that's part of the reason they want a strong dollar. I think what you've seen over the last year is the dollar's been weaponized. I think it's very easy to see that with Russia and, confiscating their assets and kicking them out of SWIFT. But you can also just use the dollar as a weapon just by letting its value rise. Because again, it puts these countries who are on the margin in a very vulnerable position. Once they're vulnerable, then you can go to them and you can say, hey, we'll help you out, but then you've got to help us out, right? So we will help you with this trade deal. We'll help you with your, US dollar debt. We'll help you with whatever problems you're having, but then we're going to expect your vote on the next UN Security Council or the next trade deal or next, agreement. So the dollar, I think, is being used as a tool, for lack of a better word, to kind of, shore up their side of the team. And so I don't think that they want a Plaza Accord right now. I do ultimately think that's what's going to happen. I think, down the road, whether it's 6 months from now or 2 or 3 years from now, I think the dollar will get to a point where they were going to have to write it down or have to devalue it. And I think it would be some type of a Plaza Accord type thing when that happens.
What do you think the chances are that the countries that they're not aligned with the US, if they feel that they're being impacted too much by a weaponized dollar, that they could break away? And what I'm talking about is the potential for non-dollar currency grouping that maybe involve China and Russia. And it's something that Credit Suisse is, I always get his name wrong, Zoltan Posnar has mentioned about commodity-based currency. So what are your views on that? Do you think that it's a non-starter, even though it might in theory look like something they could pull off?
Well, I think the right way to say this is that I agree with what he is saying as far as perhaps what some of these other countries want. And I agree with what he's saying is what they may try to do. Where I start to disagree is with the people who say, yes, that's what they're going to do, and it's automatically going to be successful, and that automatically means that the U.S. is going to lose global reserve currency status. The example I've kind of used, well, I've used a couple different of them, but one of them is it's very easy to say you're going to do this. It's actually very hard to do it in real life. And, I should say that, this BRICS currency, this is not the first time this has been brought up. Years ago, when they first formed, I think it was 15 years ago, it was always talked about maybe this was a potential trade bloc or a potential currency bloc. This has been kind of floated various times over the last 15 years. But again, it's just very, very hard to actually do it. And the analogies I've used is, I could make an announcement today that I am going to become the greatest golfer in history. And I could quit my job and I could go practice 10 hours a day for the next 5 years. And that doesn't guarantee that I'm going to become Tiger Woods, right? Just because I say I'm going to do it and just because I work at it doesn't mean it's going to be successful. Not only that, there could be a number of negative things that could happen to me along the way. My income probably goes down substantially. My family probably leaves me. My friends probably stop talking to me. I get blisters all over my hands. So the point is I think that there is a desire to de-dollarize. I think that there is coordination among some blocks of countries that realize the dollar has been weaponized and they would like to get out from underneath it. I think it's very, very hard to actually to do it without there being significant amount of pain. And so as part of my theory is that even if I'm wrong, that this will not be successful. If these other countries are successful in de-dollarizing, I think that process of de-dollarizing would actually be in the short term positive for the dollar. So what I mean by that is if they successfully de-dollarize, it means they have to get rid of their US dollar reserves, their US dollar debt. And I think that process would be volatile, not just from an economic basis, but probably even from a military basis. And I think that upheaval, that uncertainty, that volatility would lead to the dollar spiking in the short term before it would ultimately fail. So I'm not against this de-dollarization idea. I'm not going to pretend that countries don't want to do it. I'm less convinced they can actually do it. And then I'm also convinced that if they do it in the short term, it would actually lead to dollar strength than weakness. So it's really interesting to watch. I just don't take it at face value the way some of my colleagues do, I guess is the right way to say it.
Okay, interesting answer. I was going to ask you where gold fits in all of this, and I was going to be a two-pronged approach to briefly discuss the price of gold as it is now and why it's not reflecting the geopolitical risk, the high inflation rates, and that the dollar is the asset that's doing that. And also to get your view on where do you think there are structural imperfections in the way that gold is priced, the gold price discovery, that could explain why gold is not reacting the way that people traditionally think it should in these environments?
Sure. So I think the best way to explain this is that I actually think, just so everybody's clear, is I actually don't love the dollar. I know a lot of people think that because I think it's going higher, I'm a big fan of the dollar. I'm actually not a big fan of it. I think I've kind of figured out how it works. That said, I'm a huge believer that gold will ultimately go much, much higher. And I think when all is said and done, and regardless of whether we continue to have fiat currency or whether we have something along the lines that Zoltan Posnar has positioned, I think gold does very well in the long term. And I think ultimately it wins, for lack of a better way of saying it, some kind of a sovereign debt crisis. Because as you know, there's no counterparty risk. It's been around for 5,000 years. It can't be debased, can't be inflated away, et cetera, et cetera, et cetera. Right?
Yeah.
So for all those reasons, I think gold will be the ultimate winner. That said, the reason and the reason that I believe that, and part of the reason that kind of underlies the whole milkshake theory is the amount of work that I've done to kind of understand how the system is designed. And that's understanding how the system is designed is ultimately what led me to believe in gold. The system that we have designed is mathematically guaranteed to fail. It's just a matter of when. And I honestly don't know whether it's a week from now or another 50 years from now. But from a mathematical perspective, it will crash. And I don't have time to go through all the reasons that is, but it's basically an exponential system. The design of the monetary system means that the monetary system has to grow. If it doesn't grow, it collapses on itself. And so in that collapse, I think gold does very well. Now, the reason I don't think it has done very well in US dollar terms is because in many ways, I think that gold is a crisis hedge against a currency crisis, right? The US dollar is not in a crisis right now. You may think it should be, and you may think it will be, but right now it's not. Right now it's at a 20-year high. And so gold doesn't need to do a lot in US dollar terms right now. People in the United States don't need gold. If you flip it around, though, if you look at gold in euro terms, it's near an all-time high. If you look at it in yen terms, it's near an all-time high. You look at it in Turkish lira, it's near an all-time high. The point is these currencies that are in trouble, these currencies that have fallen a lot, gold's doing very well in those terms, right? And so, you know, so for citizens that are not denominated in US dollars, gold looks just fine, right? You know, and I think so. To me, that tells me that gold is doing exactly what it's supposed to do. And I think at some point when the US dollar does get into crisis, then gold will do very well in US dollar terms as well. One thing I would say, and maybe this will help people kind of understand the milkshake theory in a little bit different ways. I think and this is partly going to answer your question about how gold is priced as well. I think many people who are invested in the precious metals world understand the leveraged effect of gold, meaning that if you look at the way gold is priced, it's off of the futures exchanges that trade, you know, how many millions of ounces of gold when there just really isn't that much gold in existence. If everybody stood for delivery, there's not enough gold to satisfy all that gold demand, right?
Right.
And so from that perspective, you could say that the price of gold is not accurately reflecting the underlying supply, right? And if and when people actually stand for delivery to get that physical gold, the price of gold has to go much higher to satisfy that. The interesting thing to me is that, well, first of all, I should say, and that's why in the Great Depression, you know, that's why the US wanted gold, because gold was becoming very valuable, right? And so they confiscated that gold ahead of the Great Depression. Now today, gold is no longer underlying the system. We're no longer on a gold standard. We're now on a dollar standard, right? So the dollar is what is underlying everything. And in the same way that there's a lot more contracts that are traded on gold than actually physical gold that exists, that same thing exists in the US dollar world. There's the monetary base for the dollar, and all other dollars in existence have been loaned into existence. You can consider all those other dollar claims like the contracts on the gold futures exchange, right? When all of those claims actually start asking for delivery of the cash that underlies it, there's not enough cash to go around. And that pushes the price of the cash up. And that's the price of the dollar. So in many ways, what you could say is happening to the dollar over the last year is there's a short, just in the same way that there could be a short squeeze on physical gold, there can be a short squeeze on physical dollars, and that's the price of the dollar. And so as global growth has slowed, as people and institutions around the world have struggled to pay their US dollar debt, as they've tried to cash in those claims in order to get the dollars to pay off their debts or their trade or whatever, it's pushed the price of the dollar higher. And that's why I ultimately think it will end. It's a game that cannot go on forever. But while it exists, the dollar could go higher than many people think, just in the same way that at some point gold is going to go much higher than many people think possible as well. It's just a matter of which one plays out first. I happen to believe that the dollar spike will come before the gold spike, but ultimately I think the gold spike will outperform the US dollar spike.
Do you think there could ever be a situation where the way that gold is being priced right now, be it the LBMA unallocated trading market or else the COMEX gold futures market, could cease to be the dominant pricing venue and that it could shift to a physical pricing venue?
I think it's possible. I think it's possible. You could even say probable, but it's just not something that I necessarily think is going to happen, next week or next month. I think it kind of, to a certain extent, will coincide with, whenever they do this reset or this Plaza Accord or whatever it is to kind of solve this currency crisis. And I should say also, this is not me saying that I think the dollar is going to go up for several years and gold's going to go down for several years. I think as we get into a global sovereign debt crisis, and I think as currency and sovereign debt gets repudiated, I think that capital will flow to dollars, but I also think it will flow to gold. So I think you could see the dollar and gold rising versus all other foreign currencies together. Now, they can't rise versus each other at the same time, but those two could outpace all other currencies. And I think that's ultimately what will happen. And then ultimately, I think gold will outpace gold will outpace the dollar as well.
So in your day job as the portfolio manager and CEO of Santiago Capital, all of your macro views, do you implement those into your investment philosophy and asset allocation in Santiago Capital?
Yeah, I do. And so, what I do at Santiago Capital is I work with individuals. The individuals are my clients. So I'm not managing big pension funds or endowments or anything like that. And because I work with individuals, I customize every individual's portfolio to them because not everybody has the same needs or wants. So I'm not managing a mutual fund where everybody's doing the exact same thing. That said, my ideas and my philosophies, they all show up in client portfolios. So even though no two people have the exact same portfolio, a lot of them have similar portfolios or at least similar themes playing in them. And I think the way I've kind of always worked with clients is I've always kind of used the same framework to explain to them the way we need to think about markets. And then based on their own specific situation and where we are in certain cycles, we customize it from there. But the framework that I often use is one that you've probably heard about and perhaps other people have heard about too. And the framework I use is the permanent portfolio. And the permanent portfolio, at least my version of the permanent portfolio, basically, and I've gone back and done these back tests and looked and see how these have done. And if you put 25% of your money in cash or fixed income, 25% in equities or some kind of a business, 25% in real estate, and then 25% in gold, precious metals, maybe some miners, diamonds, some kind of like hard assets. If you just had those four asset classes over the last 50 years, you would have made basically the same return as the S&P 500. The difference is that you never would have had a down year that was down more than 13 or 14%. And you have only lost money 5 or 6 times over a 50-year period. Now, the S&P 500, you would have made maybe a little bit more than this permanent portfolio, not very much, but there would have been several years where you had a 30, 40% drawdown. The volatility was crazy. And so you would have had all these swings without gaining that much extra gain for doing it. And so the point is it's kind of slow and steady. The turtle wins the race, right? And when you have those, the reason I use those 4 asset classes is if you have those 4 asset classes, you will survive anything. You'll get through whatever happens, whether you have inflation, whether you have deflation, whether it's an economic boom, whether it's a severe recession. whether you have sovereign defaults or whether you have higher rates of inflation, your portfolio is prepared for all of those. And the interesting thing to me is that if you look back throughout history, many of these families that have had multi-generational wealth, that have passed wealth down from one generation to the next generation over 200, 300, 400 years, the reason they've been able to do that is they do some form of this permanent portfolio. They have their businesses, they invest in stocks, but then they also all own real estate. They also all own precious metals or some kind of art, these real assets. And the reason they are able to sustain that wealth is because they're ready for everything. And if you just get through, survive, I call it survive in advance. You just want to still be alive the next day. You don't necessarily want to charge headfirst into every battle because you might get shot down, right? But if you just survive, and let your money compound over long periods of time, you end up doing very, very well. So that's why in all my client portfolios, there's some degree of gold. All my clients have real estate. We have equities for all of our clients. For the last year, we've had them hedged because we thought there was going to be volatility. Thankfully, we had those hedges in place because those have helped us a lot this year. And then on top of all that, we also, because we believe the dollar is going to get stronger, we'll play with a small percent of the portfolio, maybe 5% of the portfolio. We'll do very high risk, very high reward trades based on the dollar getting stronger. Because if the dollar does get stronger, it will have these knock-on effects that could make events happen that people just don't think can happen. And so when things happen that you don't think can happen, the payoff can be very big. And so that's a situation where our 5% could become 20% or 25%. And if we're wrong and that 5% doesn't do well and the 5% goes to 2%, well, then that means the other 95% of the portfolio is doing very well. So we kind of use the combination of the permanent portfolio and then my view on macro markets to kind of come up with a whole solution. I'll tell you one other thing, the reason that I think that this works. If people are trying to figure out how to implement something like this in their own portfolio, one of the good, so I kind of think of, 95% is my long-term portfolio and 5 to 10% is my short-term portfolio. I think as investors and as people who are interested in markets, we always feel like the need to do something. We see this, we want to trade it. We do that, we want to do this. If you do that with a small percent of your portfolio, it kind of scratches that itch of wanting to do something. But doing it in your short-term portfolio keeps you from doing it in your long-term portfolio. So in other words, you can kind of set your long-term portfolio and just let it run for very long periods of time. Whereas if you just had one portfolio, I think you would always be kind of wanting to tweak this or tweak that, or get out of this asset class and get into that asset class, rather than just letting it sit there and compound over, several years. But if you have that small portfolio, it allows you to kind of go in there and, have your fun, do your trades, talk about it at cocktail parties, but it doesn't screw up your entire portfolio.
Yeah, human nature being what it is,
yeah,
it's difficult for a lot of people to be disciplined as regards investments. See the latest craze or the latest asset class going ballistic and want to get in on it. So that's very good advice. So I know we're going to wrap up in a few minutes, but what's your outlook for the next few months as we go into the end of 2022? Are things going to get dark in the financial world?
Well, I think in some ways things are already pretty dark.
Yeah.
I think the first half of the year was very hard. We had a nice bounce. But then in the last 2 or 3 weeks, we've had another very hard sell-off in the last 2 or 3 weeks. I think sentiment is very low. Sentiment on equities and risk assets is very low. Sentiment on the dollar is extremely high. I think everybody now is starting to realize, hey, the dollar could go a lot higher. Now that it's not quite as surprising, it wouldn't surprise me if the dollar pulls back a little bit and we get another little bit of a run, maybe for a month or two. But I should caution, I don't think that we're back to like blue skies, everything's fine and everything's just going to go up from here and the dollar's going back to 80 or 90. I think we might have a month or two of a risk on bounce, but I would say by the end of the year into next year, we're probably going to see a lot more volatility.
So Brent, it's been great having you on the show. Maybe in early 2023 or some way midway through 2023, we could have you back on again to get a latest update on what's happening at that time.
Yeah, I'd be happy to do that. I've been a fan of yours and BullionStar for a long time, so I'm happy to come back whenever you think it's a good time to do so.
Oh, great. We'll keep that in mind then. So thank you very much for your time, Brent. And I know everyone's going to find this very interesting.
Okay. Good luck, everybody.
Thank you.